Yo, what's the dealio, man? Listen, you already know I got a straight banger for you today, all right? So in this video, what I want to talk about is choosing the perfect contract. And I want to break down all of the small intricacies, the things that are working for me, the things that are not working for me, right? This isn't just a beginner video, right? No, like I want to break down some real deep intricacies about choosing your contracts based on what has worked for me, right? And the percentages I've been able to see, right? So I want to keep that in mind. Okay, keep that in mind as you're watching this video. Now, what we're gonna do is we're gonna go technical first, right? So I'm gonna talk about the technicalities, and then I'm gonna go to the whiteboard and to the charts, and I'm going to show you and illustrate what I mean based on the technicalities of what I'm explaining to you. Okay, so I want to make sure that by the end of this video, you feel like you elevated your game when it comes to stock options and knowing which contracts to actually choose. Okay, so I'm going to pull this up real quick, and then we're gonna get started. All right, so as you can see right here, this is my mobile Weeble, right? Now, these are stocks that are on my watch list, right? Now, we're gonna go to an options chain, and then I'm gonna break these things down from a technical perspective, okay? So let's go to applied. All right, then we're gonna go to options. All right, so this is the options chain. If you're new to the channel or you're a new trader, this is how you choose your contracts, right? So on the left side right here, we have calls. So you think the stock is gonna go up. On the right side, we have puts. You think the stock is gonna go down, right? So when we're looking at contracts to choose from, we wanna keep in mind a few things. Usually the first thing is the strike price and also the expiration date, okay? So right here in this example, the stock price is at 37.76, right? So we have at the money contracts at $38 and $37. We have in the money and we have out of the money, right? This can get a little bit confusing to most people, but if you watch these videos enough, it'll become second nature to you, so don't worry about that. All right, but these are the things I want to bring to your attention. To the left, right, in the middle right here, we have the strike prices. The left is calls, the right is puts. So let's focus on the left side, which is calls. So we have the bid and the ask, okay? The bid is the lowest price that this stock is, this option contract is being bought for, and the ask or sold for, and then the ask is what they're asking to, like the highest price, right? So basically the low and the high. Very simple. All right, I do not want to overcomplicate any of this stuff. Next, we have the last. The last is what is the last price that this contract sold for? And then we have the percentage change. So this will let you know the percentage that these contracts are up or down on the day. All right. And then when we go over, we have volume. The volume is important. Volume is how many people are trading these contracts, all right, in this day. You don't want to really trade stock like contracts that have low volume. You can, but it may take a little bit longer to get filled and things like that. And also it's just kind of like, why not go where the money is at, right? But you really shouldn't have to worry about volume too much, because as long as you're getting like common sense contracts, you'll be fine. The next thing is going to be open interest, okay? This is something that I pay attention to right here, right? So you see we got the ask, the last, the change, the volume, and then we got open interest, right, on the left side. So the open interest is basically saying how many people have bought into this contract or have this contract, right? So for applied, the open interest is really good across the board, top and bottom, right? So you see that we're over 1,000 on the open interest on all of these contracts. That's actually very good, right? If we go to the put side, open interest, you see how the open interest the is at 1,000, 2,000, right? When we're talking about out of the money contracts, but in the money contracts, it's under 700 or 730, right? So there's less open interest for in the money puts on applied, but there's way more open interest on out of the money puts, but there's also way more open interest on calls out of the money and in the money. So what that lets me know is people are a lot more bullish on applied than they are bearish, okay? And if they are bearish, the bearishness could be just a short-term kind of thing. All right, now we scroll over some more. We got implied volatility. Now, implied volatility is very important to understand. So basically, this is how contracts get fluffed up, right? When you're looking at the ask and the bid right here, it's called a premium, right? The premium gets pumped up also when the implied volatility gets pumped up. So if a stock is becoming very popular, you're going to see a lot more implied volatility. Or if a stock is going crazy that day, you are going to see the implied volatility go through the roof. So we have applied right here. These are the weekly contracts. That's this week's expiration. And they're at 145%, 148% implied volatility. This is basically saying that this is the percentage that people think that a stock is going to go up or down in a direction because it's volatile, right? When a stock makes a big move to the upside, the implied volatility is going to go up. Or when there's a lot of open interest and you have a lot of people thinking that a stock is going to keep going up and pumping, the implied volatility is going to continue to increase. And so what that means is you're going to be overpaying for your contracts. All right. This is very important to understand, right? Because if you overpay for your contracts and then the stock starts to go in the opposite direction, what's going to happen is you're going to actually lose money a lot faster because the implied volatility was so high. And if the stock starts going the opposite way, the implied volatility is going to start dropping, right? So next we got the delta and the theta. The delta lets you know how much money you're going to make per contract. So basically, you will make X amount of dollars per contract for every dollar that the stock goes in your direction. So let's say that I want to get the 38 strike price, right? What that means is for every dollar that Applied Digital goes up, I will make $47 per contract. So on a $1 move, I will make $47 per contract. So if I get 10 contracts, right, and I buy in at $143 and I go put $1,400 in this trade, if Applied goes from $37.76 to $38.76, that means that I will have made $400 because $10, 10 contracts times $47, that's $470, right? So that's how that works. And that's like that's like a little bit less than like 30% return, right? So, and then we got the theta. Basically, the theta is letting you know how much the contract is going to decay, okay? So when we start going out of the money, right? So if the stock is at 37.76, anything where the stock has not reached is out of the money because the stock is trying to reach and get there, okay? Anything below the stock price is in the money when we're talking about calls because the stock has already been there, all right? So theta is letting you know how much it's going to decay. Now, if you have a out of the money contract, like stock is at 37.76 and you have a strike price of 46, it's going to decay very fast because it's so far out of the money and the theta is high or low, and then so is the delta as well, okay? And then it lets you know the in the money percentage. I don't really pay attention to that too much. But so these are the things that you want to think about. And then we also have the expiration date. So right now, this is the week of October 17th, right? This is this week's expiration. So we have the 24th, which is next week. You have the 31st, which is the week after, right? Now, when we're thinking about contracts and what contracts should we get, we also want to keep in mind, okay, what type of move can this stock make? What kind of move am I looking for the stock to make? Also, how long do I plan on being in this trade, right? If this is a swing trade and you plan on, catching the trend, then you may want to get a month and a half out, right? Because it may take 2.5, 3 weeks for the stock to reach that target. But if you want to just swing something overnight or for 1 or 2 days and it's Monday, then you may be okay with doing the same week's expiration date. Okay? Now, the same week's expiration dates contracts are always going to be cheaper than the further out. The more time you buy on your contracts, the slower they're going to move, right? So if I was to get into a call for applied right here for this week, if the stock moved, let's say $1, I may be up 35%, right? If I get next week's contracts and the same move happens, I may only be up 26%, okay? So that's what you need to think about when you're looking at choosing your contracts as well, okay? Now what we're gonna do is, let's go to the whiteboard and let me break a couple of things down when we're talking about choosing the right contracts, okay? So let's say you want to enter into a trade, and let's just stay on Applied Digital. So the stock is at 37.76, okay? That's where the stock is at, and you're on APLD, all right? So you want to ask yourself, okay, first off, what type of trade is this, okay? Is it a scalp, day trade? Is it a swing? All right? This is something that I always ask myself, because if it's a scalp, then I may say, okay, I'm going to get a little bit further out of the money. Okay? But if it's a overnight swing trade, I may get a little bit further out the money. But if it's a swing trade, I may get a little bit closer at the money. It does just depend. So you want to ask yourself, okay, which type of trade do I plan on getting in? And what this is going to do is, this is going to actually slow you down from making brash, random decisions just because, okay? Now, when I'm choosing, let's say, a swing trade, I'm going to be looking at the open interest, okay? So on a swing trade, right, I'm going to be looking at the open interest, right? I'm going to pay attention to that because I want to choose a contract that has a high amount of open interest. It could be 3 levels out of the money. I may be okay with that because that open interest, it gives me a little bit of a indication of how many people, right, think that this stock is going to also go into the direction. All right. So that's something that I'm always looking at when I'm thinking about contracts. Now, another thing that I'm thinking about in regards to contracts is, right, how fast ITM, okay, how fast can this contract get in the money? I will ask myself that. So here's what I mean. Let's say that we have APLD and the stock is at 37.76. And let's say, right, let's go up here. Let's say that the stock is right here, okay? and this is on the daily, and let's say we have a gap right here, okay? And let's say this is at 37.82, okay? And we have a gap right here. And let's say this price, this is applied. Let's say this is $41. Okay? Now we have a gap, and we're about to the stock is about to close, right? Market's about to close. And I want to swing this right here. I may say, okay, I'm going to swing this overnight, and I'm going to look at the strike prices, and let's say the 41 strike price, let's say we have a 41, a 42, right? And then we have a 40, okay? And let's say the 41 has 1,000 open interest. Let's say the 40 has 2,000 open interest, and let's say the 42 has a 4,000 open interest, right? I will get the 42 strike, right, to swing it overnight, because if the gap starts at $41 and let's say it goes up to 47, right? So we have a gap fill. Actually, I did this wrong. 41 right here. And then, my bad, y'all. Actually, okay, let's say the gap started at 38. Okay, let's do that. Let's say the gap started at 38. Okay, and it went to 47. That's better, right? So we have all of this room to fill right here. And this is a $9 range right here, okay? So this is a $9 range, right? So I'll probably get that 42 strike price right here because it's out of the money. It's a very cheap and affordable contract, but it's not all the way up here, right? I'm okay with getting half of a move. And what I just said, I'm looking at how fast can a stock get in the money, right? If I get in this trade at 12:55, 5 minutes before the market closes because I'm on the West Coast, and then overnight I get a 42 strike price, and let's say overnight it gaps up to $43, by the time I wake up, that contract is going to be in the money and it's going to print, right? So this is like things that I'm looking at when it's time to enter into a swing trade. I like doing a little bit out the money because they're cheaper, but also if they do move, you'll get a higher percentage return, okay? You'll get a higher percentage return. But the more in the money, you'll still make money, and it is safer. In the money is always going to be safer, but out the money is going to be riskier because they do decay faster. But if you are a sniper and you're like, you know what? I think that I see that this stock can get here very fast, like a gap up overnight, or we're trending today, we're exploding, and we're at the beginning of our breakout, and I know where the stock is going, I can get an out of the money contract. Okay? So this is what I'm thinking about when I'm saying, okay, I'm going to enter into trades. Right? Now, the next thing that I'm thinking about when I'm entering into trades is the move, okay? When I'm looking at the move. Now, what I'm going to do is we're going to go to the charts, and I'm going to show you guys exactly what I'm talking about. Okay? When we're looking at a stock making a move, you always want to make sure that there's no points of rejection for the stock to get where it's going, right? So what do I mean? You don't want any real resistances, okay? So a bull flag breakout, all-time high breakout, okay? A massive gap to be filled. These are times where I'm gonna get a little bit more out of the money because I see a bigger move happening. I could put less money into the trade and I can make a bigger return on that trade, okay? If I wanna scalp, if I'm gonna get an out of the money contract, I wanna make sure that there's not a lot of EMAs and levels to have to get through because it's gonna take time, right? I want you to understand that when you're trading, time is money, right? Time is money, time is money, time is money. And the contracts, they will decay, okay? So now let's go to the charts and let me break this down for you guys so you fully understand what I'm saying, all right? So let's go to, this is DraftKings. Let's go to right here. All right. So let's say this is HIMS. All right, this is a good example. So HIMS, they made a nice move, right? On this candle right here. This isn't one day, this is on a daily time frame. So as you can see, right? This was yesterday. This was on Tuesday. All right. And then this right here is on Wednesday. Right. And look where they went to, all the way to 65. They made a crazy move. So when I'm looking at this, if I wanted to enter into this trade, I wish I would have saw them. I would have traded them. But if I wanted to enter into this trade, I'm going to look at this right here. So this is 56.27. All right. And then I'm going to look at the next level, which would be 59. Okay. So because there's no resistance besides this level right here, I would say, okay, we're at 55, 55.50. I'm going to get a 59 strike price. Okay, 59 strike price. And I'm going to ride this thing up because the next level will be to right here at $59. Right? Because we have this, we could retrace all the way up to here without any, without any rejections for real. And if you go to the 30-minute time frame, look what happened. All right. It just trended up all day. Didn't really have any harsh rejections. It came down right here, but that's it. And then it went crazy, right? And went super crazy the rest of the day because there wasn't any real resistances, right? If you look over, there's not any real resistances. It got up above here, right? And it just went crazy. But above here, right, above here, there wasn't any real resistances until right here, right, 59, which is what I said. So when you know where the stock is going, like, look, once we got above this level, right, once we got above this level right here, there's no resistance, okay? So you just see where the stock rejected from, and you could get a strike price right there before everybody is in it, right? Before everybody is all excited about the stock, pumping it up. And then you could be a beneficiary of the stock pumping up. All right. So this is what I mean when I say choose the strike price of where the stock is going. Right. And if we go to HIMS, right, this day, let me show you guys this. If we go to HIMS right here, look at the contracts, okay? The 59s, they did 1,000%, okay? Look at this is exactly what I'm talking about. The contracts that were already closer to being in the money, they made less. You see what I'm saying? These are weeklies. But when I said I would have got the 59 strike price, those contracts pumped up 1,000%. But if I would have got the 56 strike price, I would have only made 500%, right? So yes, these were less expensive and a little bit more of a risk, but look at what they did. 1,000%. Look at these out of the money contracts, the 65 strikes, 2,000%. Okay. And then look at the open interest as well. On the 59s, there was 3,000. On the 60s, there was 18,000. All right. So this is what I mean when I'm saying at the time, HIMS was at $55. Okay. So you guys can see that HIMS was at $55 at the beginning of the day, right? If we look at it right here, okay, let's zoom in a little bit more. Right here, they opened up at 55.05. Then they came up right here, okay? So they came up above here at $55, 56. So if you would have got at the money, you would have hit 500%. That's not bad. I'm not knocking it. But if you would have knew that the stock, right? If you would have knew that the stock's resistance level and where it came from was at $59 right here, you could have said, okay, I'm gonna get the $59 strike price. And then you would have been up 1,000%. And that's the difference between 500% and 1,000% is the strike price, knowing your levels and knowing where a stock can go and where it can reject at, right? So this is extremely powerful. That's a 500% difference. That's two 500% trades between two different contracts by just knowing where a stock can be going to. Okay? So I hope that helped you guys out. This is what I mean when I say knowing how to choose your contracts, from day trading to swing trading to scalp trading. It's all the same from the perspective of you have to know what you're looking for and you have to know what your game plan is. If you just waking up and you saying, I'm gonna just trade, you're not gonna be successful. You're not gonna be able to maximize the opportunity of the stock market. But when you understand what's really going on, you can make some serious money in a very short period of time, all because you know where things are going. All right. So I hope that helps you guys. If it did, let me know in the comments, right? Let me know what you guys think, what you guys liked about the video. All right. Like I always say, make sure you get up out your head, go get into this world, because your head is a dangerous place to live. All right. And also remember, y'all, the more you study, the less you worry. All right. Y'all stay smooth, man. I'm going to see you on tomorrow's video. Peace.